the Reserve Bank of Australia has now increased the cash rate by another 25 basis points, taking the cash rate to 4.1%. This of course is not great news for anyone who has a mortgage, or who is looking to go out and buy a house, because now one's implicit borrowing capacity might have decreased, and the mortgage payments on existing mortgages will have gone up. Now, as undesirable as this cash rate increase was, it wasn't entirely unexpected. After all, the latest quarterly CPI reading came in at 7% year on year, and the latest monthly inflation reading was 6.8% year on year, suggesting the RBA is struggling to get inflation back down toward its target of 2 to 3%. Not only that, we've got a rather tight unemployment situation. The unemployment rate is 3.7%, a slight tick up from the prior reading, but still rather low. Furthermore, wages are continuing to increase, at least for some sectors. The minimum wage was recently increased by 8.6%, and the award wage was increased by 5.75%. This is a sizable increase that could potentially be inflationary in nature. Furthermore, from a business perspective, the actual cost will have gone up, because the businesses then need to pay payroll tax and other things on top of that 5.75 to 8.6%, suggesting businesses are now going to bear an even greater cost, which they might ultimately pass on to consumers, which would be inflationary. You add on to this productivity woes. The RBA has noted in the past that productivity has been languishing. The GDP per hour worked has actually been declining over the last couple of years. Now, this is probably unsurprising. After all, if people are being paid less in inflation-adjusted terms, they're simply not going to go above and beyond. So whereas in the past, someone might have been employed for 35 hours per week and they might have actually worked 45, thereby making productivity look incredibly high, when you're looking at the official number of hours they're employed for, well, they might simply start to quiet quit. They might work to rule. Therefore, the number of units of output per hour officially worked will have decreased. That is, people might have been working 45 hours before, whereas they were officially employed for 35, but now they're just working 35 hours. So the number of actual output units put out will have declined. Furthermore, Australians seem to be picking up second jobs. This again is relatively unsurprising. After all, if they're now being paid less in inflation-adjusted terms, well, they're going to need to make up for this with a second job. And this, therefore, will feed into productivity data, or feed into it in a couple of ways. First, the number of hours actually worked in the official data will tick up, because whereas they might have been doing unpaid overtime before, they're now actually being paid for their second job. So the number of hours in the denominator of GDP per hour will have gone up. Furthermore, the actual amount of units of output per hour at this second job will probably be relatively low, because that second job is likely to be relatively less skilled. It's likely to be relatively more junior than the primary job. Their unit of output from a GDP perspective might actually be relatively low, and therefore you end up with a productivity decline. The person's hours would have been better spent at their primary job. Because the primary job isn't increasing their salary, they pick up a second job where they're perhaps producing less GDP per unit of hours worked, and therefore productivity appears to decrease. As a result, the RBA is rather in a bind. They're in a situation where unemployment is rather tight, a situation where wages seem to be increasing for some parts of the economy, a situation where people are not going to go above and beyond at their workplace. People are more likely to pick up a second job rather than work more hours at their primary workplace, thereby making the productivity data look even worse. And therefore, the RBA felt that it needed to increase the cash rate. It's also quite possible that future rate increases might occur. However, of course, this will depend on what data will come out after this current rate increase. And indeed, if things start to deteriorate significantly, if unemployment really picks up on the back of these wage increases, then we might see the RBA backing off. However, that is going to depend on the data going forward. And be interested to hear your thoughts about where the RBA's cash rate will ultimately end up being. And in any case, those are my thoughts about what the RBA is doing and what's happened with the cash rate. If you think I've missed anything, let me know that in the comments below. And otherwise, thanks a lot for tuning in. Don't forget to subscribe, and hopefully I see you next time as well.